Year-end close is one of those things that sounds intimidating, but it doesn't have to be. Whether you're a business owner closing your own books or a bookkeeper responsible for client files, a clean year-end close is what sets the stage for accurate, clear financials and a strong start to the new year. Today, I'm going to walk you through a practical step-by-step process on how to do a proper year-end close without overwhelm. Hi. I'm Sherelle T. Martin, founder and CEO of Nitram Financial Solutions, where we teach bookkeeping without boundaries. We help CEOs and teams eliminate financial chaos, fix money leaks, and build scalable bookkeeping systems so they can increase cash flow and maximize profits without overwhelm. Want to learn more? Be sure to like, comment, and subscribe. Let's dive in. Step 1. Record all bank and credit card transactions. The first step in any year-end close is making sure everything is recorded. Everything. That means every bank transaction, every credit card transaction, and every PayPal, Venmo, and Cash App transaction through the end of the year. All of those transactions needs to be on the books. No missing deposits, no missing expenses. If transactions are missing at this stage, everything comes after that will be all wrong. Think of this as your foundation. If it's shaky, the rest of the process won't hold. Step 2, reconcile bank and credit card accounts. Once all of the transactions are recorded, it's time to reconcile. Reconciling means matching what's in the accounting software to your bank, credit card, PayPal, Venmo, and Cash App statements. This step confirms that your cash and credit balances are accurate. If something doesn't reconcile, that's your signal to stop and investigate. Year-end is not the time to force numbers to work. It's the time to fix them. Step 3, reconcile loan accounts and record annual interest. Next, review all of the loan accounts. Your loan balances in the books should match what the lender statements are exactly. This includes separating the principal payments from the interest expense, because remember, only the interest portion is deductible, not the principal. At year end, you also want to make sure that all interest for the year has been recorded, even if the last payment posts in January. This ensures that your liabilities and expenses are accurate. Step 4, reconcile payroll accounts and payroll returns. Payroll is one of the most commonly misreported areas in bookkeeping. At year end, payroll expenses should tie out to your quarterly and annual payroll returns, and liability accounts should only reflect the federal withholding, state withholding, and payroll taxes that are still outstanding. If payroll accounts don't reconcile, it's a huge red flag that something misposted or not cleared correctly. Fixing it now prevents major headaches later. Step 5, verify equity accounts against the last tax return. This step is often overlooked, but it's critical. Your equity accounts should match the ending balances on the last tax return that was filed. If they don't, it usually means one of two things. The prior year end adjustments were never recorded properly, or transactions in the prior year have changed. Obtain the prior year end adjustments from the tax accountant and post those to bring the accounts up to date. If the variance is due to a prior account balance that has changed, because people are always changing things, change it back and make whatever that adjustment was in the current year. Once a return is filed, the books cannot be changed. They are locked. Equity is not a plug account. It tells the story of a business over a period of time. Make sure that the story is accurate before moving forward. Step 6, review balance sheet for red flags. Now it's time to scan the balance sheet and the profit and loss and ask simple questions. Does this make sense? Look for accounts that have balances that go the wrong way, like negative asset balances, liability accounts that never clear, or old credits sitting on the books. These issues often come up from missed postings, unapplied payments, or prepayments that were never reclassified. Step 7, scan for fixed assets in expense accounts. Now it's time to review office expense, repairs and maintenance, and office supplies, because those are the ones that are most often hit with transactions and items that should be fixed assets. Generally, we'd like to say that anything that's $2,500 or more should be capitalized instead of expensed. This step ensures that fixed assets and depreciation are accurate and that the financial statements reflect the true value of what the business owns. And step 8, review expense accounts for missed postings and inconsistencies. Finally, review the remaining expense accounts. Review the transaction details of every account you're looking for You're looking for expenses that don't belong, duplicates, or inconsistent postings. For example, the same type of expense showing up in multiple accounts. I know that sounds like a lot, but it depends on the size of the company and the software that is being used that this can be an easy process. We use a closed software that connects to the accounting software and identifies these variances for us because we need clean expenses, and clean expenses are necessary in order to generate clean reporting. So in summary, this is your checklist. Record all of the bank and credit card transactions. Reconcile bank and credit card, all of the bank and credit card transactions. Reconcile all the loans and record your interest. Tie out the payroll and to the payroll returns. Verify the equity against the last tax return that was filed. Review the balance sheet for red flags. Identify the fixed assets and reclassify as necessary, and clean up all of the expense accounts. When these steps are done correctly, the books are clean, the reports are reliable, and tax season becomes a whole lot less stressful. If this walkthrough and this step-by-step was helpful for you, please make sure to like, comment, and subscribe. And if you are a bookkeeper or an agency owner who wants a clear picture of where your finances may still be breaking down, download our free financial clarity map. It is a CEO level checklist that helps you quickly audit and identify cash flow gaps, inefficiencies, and bookkeeping issues before they become expensive problems. You'll find the link down below. And that's all that I have for you this time. I'll see you next time. Take care.